Ivan Gruhl, Chief Investment Officer with Avantax Planning Partners. Today we'll provide a market update for December. We'll start with a recap of returns for November and then shift to an update on key factors driving the economy, the Federal Reserve, valuations, and corporate earnings, and then we'll wrap it up with our outlook going forward. The month of November brought elevated volatility driven by concerns around valuations and the future path of interest rates. After a brief sell-off in mid-November, the S&P 500 rallied into month-end, notching its seventh consecutive month of positive returns, up about 0.3% in total return for the month. Overseas, emerging markets were the lone decliner, falling by nearly 2.4%. Meanwhile, international developed markets finished the month higher, adding more than 0.6% of return in November. Despite a challenging November, emerging market stocks continue to lead the way on the year, higher by more than 30% in total return, followed by international developed markets, which are up more than 28% on the year. Here in the U.S., the S&P 500 is on pace for another very strong year, up nearly 18%. In small caps, after a slow start to the year, the Russell 2000 index has rallied and is now up 13.5% year to date. November brought another month of positive return in bonds, despite concerns around the extent of future interest rate cuts. Taxable bonds, as measured by the Bloomberg U.S. Aggregate Index, gained 0.6% in November, while municipal bonds gained around 0.2%. Year-to-date, the taxable bond index is up nearly 7.5% in total return, while the municipal bond index is higher by more than 4%. Looking ahead, we continue to believe that bonds warrant consideration in a diversified portfolio, with the taxable bond index currently yielding about 4.25% and the municipal bond index yielding more than 3.5%. As we enter the month of December, the markets are expecting to see one more quarter-point rate cut by the Federal Reserve in the final December 10th policy-setting meeting of 2025, which would leave the Fed funds rate in a range of 3.5% to 3.75% by year-end. With the government shutdown in the rearview mirror, policymakers will once again start receiving economic data from government agencies to help guide the future path of monetary policy. The Fed will have limited labor market data for the upcoming meeting, however, as the jobs report for November will be delayed from its original scheduled release to December 16th. Beneath the surface, the economy should remain on solid footing in the months ahead. As this next chart shows, the economy continues to expand at an above-trend rate of growth. For the third quarter, the Atlanta Fed's GDP Now model projects real GDP growth of 3.9%, with consumption remaining the largest contributor to growth. For the markets, valuations remain a top concern, particularly for the mega-cap technology stocks, who have benefited the most from the relentless spending on artificial intelligence. As this final chart shows, the S&P 500 looks relatively expensive based on virtually all traditional valuation metrics, currently trading at a forward price-earnings multiple of nearly 22.4 times. This is well above the 30-year average of about 17. While stocks don't appear cheap, there is good reason for the investor enthusiasm. Earnings growth for the third quarter was more than 13%, which was the fourth consecutive quarter of double-digit earnings growth for the index. While certain pockets of the market may appear frothy, this year's rally has been largely underpinned by strong fundamentals. As we enter the final month of 2025, we believe that recent enthusiasm in the markets can be sustained, but caution that the markets do remain vulnerable to potential shocks in the year ahead. Unlike past periods of excess in the markets, today's AI spending is being largely financed by very profitable companies with extraordinary margins and cash flows. However, even with strong fundamentals, markets could be poised for a correction. We believe that the recent momentum in international markets could continue, as more shareholder-friendly policies in Europe and Asia help boost earnings. International markets continue to offer very compelling dividend yields, as well as important diversification away from the technology-heavy U.S. markets. So that's what we have for this month. But before we go, we here at APP have joined the Cetera family, and this has brought new expertise and resources to us, enhancing the value we deliver to you. Going forward, these monthly videos will be replaced with our weekly series of videos, providing you more touch points to your clients, with additional focus on forward-looking content. Soon, you'll see more from our expanded investment management team, including market update videos and insights from Cetera Investment Management. Stay tuned for what's next. Thank you for watching and have a great day.